Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Welcome to episode 15 of Conversations to Have with Your Advisor. In our previous episodes, we have been discussing about markets being at an all-time high and why investors should look at de-risking and probably booking some profits in their portfolio. And we have also been emphasizing on asset allocation. Now, the question that is before us is how do we put money to use in terms of the surplus that you might have or the book profits that you have, and how we can make this work for us in this scenario?
I think it's a very interesting question to think about and a conversation that you can open up with your advisor, because the main worry for a lot of investors today is that, okay, if I'm listening to my advisor and I'm booking profits and I'm sitting on this pile of cash, and should I just keep it idle, or is there a better way for me to move forward in my wealth creation journey? Now, the most important thing is that the upward momentum in equity markets is still there. So you don't really know how long this can go on, and it can be a matter of weeks, months, or even years in certain cases when you look back at history and see how long, bull markets can last beyond rationalism and all of that. And I think the reason why advisors are advocating investors to sort of book profits, temper their return expectations, all of that is because there's a tendency today in markets which is quite clear, where market participants are ignoring bad news. It doesn't factor into their calculations. They're not prepared for downside. They're not prepared for equity to behave just like it does as an asset class, meaning most investors are not okay with ups and downs. Their benchmarks in terms of returns have also moved up. So you're not looking at compounding at 12 or 15%. People want to compound at almost double that rate at 25 or 20%, right? So given all of this, there is a need to look at de-risking. There is a need to look at other options outside of equity as an asset class. And it's not that investors don't have choices. They are quite spoiled for choice today. I think one popular option for keeping money as an alternative cash, of course, is arbitrage funds, where you do get some benefits of being in an upward moving market because you have better rollovers and those kind of things which can give you slightly better returns on your arbitrage side. A lot of investors traditionally have looked at fixed income as a space to de-risk their portfolios. And I think in today's context, it makes a lot of sense to talk about precious metals, right? This is something where not enough of dialogue is happening, and I think we can look at a few things on the precious metal side. So firstly, if we look at year-to-date performance in dollar terms, both gold and silver have delivered upwards of 20-25%, and that's pretty good for a safe haven asset class. And if we look at some of the structural drivers that are actually driving this performance, you have supply-demand mismatches, you have geopolitical risk, you have inflation, you have central banks moving towards gold as a preferred asset class over dollar reserves. So you have all of these different trends that are playing out in different capacities, which suggests that this could be a more long-term trend and not just a fad for 2024. And the common thing that a lot of investors are sort of thinking about today is that many of them feel that they already have exposure to gold and silver because they own these assets in the physical form. But I think the thing that we need to reflect on is whether this really counts as diversification, and whether investors are really doing enough justice to their portfolios with these physical assets as part of their overall asset allocation.
So now let's look at which is the best way to have exposure to precious metals, and let us discuss a little bit about your asset allocation. So all of us would have some form of physical real estate or physical gold and silver in our portfolios already. Now the big question is whether this should be considered as a part of your asset allocation and whether it should be used for calculating your current asset allocation. Now you need to understand that a lot of times when we are consuming that particular asset, for example, living in the real estate that we own or having physical precious metals, we are not going to actually easily part with it, or we are not going to be able to realize the upside that it has when the price moves favorable towards this. So we are still going to hold on to it pretty much for life or pass it on as inheritance. So when you look at the digital form of precious metals, it's a lot more easier because you will be able to capture the upside that it provides us when the cycle is favorable. You don't have to worry too much about security and storage of these assets, and you also hold no emotional attachment to it, so you will be willing to sell it and not hold on to it like the physical form. You also need to be aware that a lot of times people feel like when they hold metal in the form of bars or coins that it can be counted in your asset allocation, but that need not necessarily be the case because you'd still have to run around to be able to sell it and find time when the metal moves up. Secondly, you need to also look at certain caveats which might be there where you buy from a certain jeweler is where you can sell it back, or there would also be like making and wastage charges which will kind of eat into your returns. So in terms of counting this towards your diversification, yes, you can take it as a diversification, but it would be best to kind of like reassess and look at more from your financial assets alone, how much exposure you have towards these and how you can go about building your portfolio and putting your liquidity to better use.
There's actually quite a lot to unpack from what you said, Rashmika, and so let's take a look at the key takeaways from today's video. I think the first step is to probably open up that conversation with your advisor and talk to them about your asset allocation and see whether any of the physical assets that you hold in the precious metal or real estate basket actually count towards diversification in your portfolio. Because this will help you work towards your target. The second is, even if you are an owner of physical assets, you should look at adding a digital layer or a financial layer to these assets, simply because of the practical advantages of having a digital layer, namely transaction costs, storage, as well as quality and security. All of these things can be much more favorable in the digital version. The third important thing being that yes, it is time for you to look at diversifying your portfolio overall, looking at how to optimize risk, and precious metals are a great tool for you to implement in terms of diversification as well as risk management. We hope this video contributes towards your wealth creation journey. Let us know in the comments below.